Italy's political troubles. Is this yet another new source of risk for the global markets, or is this largely going to be contained to within Europe?
Well, I think overall it will be contained, but it is a new risk. And I think, investors have woefully underestimated the risk from politics in Europe. I mean, I don't understand why for the last 12 months or so people were saying everything in Europe is now sorted politically and it's much more stable. I mean, I think that's a really wrong view to have. There's a lot of stuff going on in Europe. You look at even UK and the kind of disarray of the, attempt to navigate Brexit and so on. It's just a very difficult situation. And I think you must not underestimate that. So to see markets come off a bit, to see a slightly higher discount rate being applied to certainly valuations in Asia and so on, I think it's actually reasonably fair. I think there is some risk from this event, but ultimately I think it will be contained.
Global markets, though, are increasingly interconnected. And if we are back to questions about the integrity of the Eurozone, then that creates uncertainty, and that uncertainty undercuts economic activity, and this has repercussions globally. And the PMI data set is already losing momentum.
Well, I think the PMI generally in Asia is still fairly resilient. So a number of countries are, actually very few are below 50 right now.
Can I challenge you on that though, Sad? Because I don't think that they are. I think that they are losing momentum really because of the uncertainty surrounding trade. So Europe, yet another source of uncertainty, another brick arguably in the wall of worry, that leads to further moderation in the PMIs, surely.
Well, you're right, PMIs have come off, but the level at which they're at is still very good. So as long as they're around 50, 51, I think given valuations in Asia, it's still, from a macro point of view, still quite reasonable. And foreign exchange reserves are also quite high. Credit spreads had also, till recently, been in control as well. And I think actually the overall macro picture in Asia is still okay, though having lost a bit of steam, as you point out. And in China as well, things have lost steam as well. PPI is still very strong, and I think growth is still coming through okay. So actually, if you align that with valuations, which are pretty reasonable, and earnings momentum, which is still pretty good in North Asian markets especially, then it's not a bad picture. I mean, certainly relative to Europe and US, which is quite expensive.
We saw today, though, that it's the banks and the financials that are traditionally the transmission mechanism for any negative feedback loop. How exposed are we out here in Asia? And if we can bring it back to your core investment theme, and that is dividend strategy, what are the implications for yields and income?
Well, we had actually been very positive with the financials in Asia for the last 6 to 9 months, even a little bit before that. And the basis for that was that as we saw a better macro environment in Asia, for example, industrial production was picking up, PMIs, although a bit lower, are still at a good level, that the NPL risk is actually lower. And certainly in China, where it's been most talked about, is a bit lower. And then in India as well, we've had some kind of reorganization there in terms of NPLs. So the scenario there is looking a bit better, but margins were also picking up. So you saw, for example, in Malaysia and Singapore, that the outlook is better. And I think dividend capital position is strong, the outlook for dividend is stronger. So you put that all together, it's quite a good bottom-up story.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.